Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
We're going to stay with Nvidia. Charlie's setting us up really well. It is down about 3 days in a row. Not about, it is down 3 days in a row.
That is confirmed.
Done. And it's a drop of about 12%. So putting it past that 10% threshold that represents a correction, on track to wipe out about $400 billion, pushing its market cap below $3 trillion. I was thinking about our weekend last week, how we said largest market cap, most valuable company. Then it went back. So it was kind of that back and forth, if you will.
Okay, but for context here, it still is up 144% so far this year. The most expensive stock in the S&P 500, its shares trading for roughly 23 times the company's projected sales over the next 12 months, Carol.
Right, but as our team writes, Tim, there's a problem with the valuation. In the age of the AI boom, no one can really figure out what the chip makers' revenues are actually going to be, not the Wall Street analysts covering Nvidia or Nvidia execs themselves. Again, our Bloomberg team reporting that out. So how are investors supposed to calculate whether or not the shares are expensive or not? So here to help us tackle that question and really get, once again, to the fundamental story that is Nvidia is Bloomberg Intelligence Senior Semiconductor Analyst Kujan Subani. He is with us from San Francisco. Kujan, it's good to have you here. We do talk with you a lot about Nvidia and the fundamental story. Remind us of that and how you see it fundamentally. What is Nvidia and the outlook for this company?
Yeah, and I want to bring back to sort of the numbers, right? Like whenever we are deviating, whether it's a hype or not, look at the numbers. Going back to sort of end of 2022, early 2023, when ChatGPT really came alive in the world. If you look at Nvidia's numbers, right, it had about per quarter revenue of about 7 billion, approximately 10 cents of earnings. This is when the first time they started to see their data center revenue, from which is all the AI, really jump. Fast forward to right now, most recent, the revenues have increased 4x. EPS has increased about 7.5x. And as of today, the market cap from that point, which was 500 billion, sort of 6x. So if you look at the numbers, it was really a fundamental driven story. So that at least should help sort of clarify some of these hype versus reality and fundamentals, whether it justifies or not.
Okay, well, speaking of justification, a lot of people talk about the idea of Nvidia having this moat. Nobody else is doing what it's able to do when it comes to building the hardware that all these companies need to train their AI models on, Kujan. So I'm wondering about when you think about projecting revenues from a Bloomberg Intelligence analyst perspective here, how are you projecting revenues out over the next few quarters, over the next few years? How are you thinking about that?
Yeah, I mean, similar to most sell-side analysts, we have also struggled to, get to the right number every quarter for them, and they keep on beating and raising. There's a few factors here. One, as you must have heard this so many times, they continue to remain supply constrained. So that's difficult for us to know, right? Like how much supply will come up and how much they can execute. And second, we keep looking at the spending pattern of their largest customers. I mean, look, in 2024, their largest hyperscale and cloud customers have already publicly announced that they are going to increase their capex by 40% year over year. And now there's even more than that. There's the tier 2 cloud providers, the AI cloud providers, and enterprise spending coming on. So we try to keep a close eye to see if there is any signs of demand slowing, which we don't see at this point.
What's the replacement cycle for chips from Nvidia? Like, how long do they last? How long will they upgrade? You know, Nvidia talks about kind of the upgrade cycle being a pretty quick one. So I'm curious, are these companies that are the big spenders and that are building it out, are they going to have to replace their Nvidia chips, I don't know, every 6 months, 12 months, 2 years? I don't know.
Yeah, that would be a good answer if you are in a normalized cycle for any chip, like you are in CPUs or for handsets. The challenge right now is all of their customers are just rushing to get the most powerful chips they can get their hands on and continue building. So we have to wait and reach a digestion phase where they sort of reach a normalized spending period and they start thinking about, okay, now I'm going to refresh my older AI chips. So right now, I think this replacement cycle is really short, even if you want to call it a replacement cycle. As they come out with the newer Blackwell chips, their newer Grace Hopper, 200 series, customers are just picking them up and trying to put in as fast as possible, because the biggest gating factor right now in upgrading these AI servers is power. So every new chip brings a lot more TCO, a lot more power per performance efficiencies.
Kunjan, we can't let you go without asking you about potential competition here in the space. It's something we ask Ian King a lot about. Who else out there is doing something, at least on the development side, that could get close to Nvidia? What's your perspective there?
I mean, on the merchant silicon, it's the only other name viable contender there is AMD, which we have talked about multiple times. Again, they are also but look, the system software mode that Nvidia has, even with a good GPU solution, it's very hard to beat that. On the other end, there's the competition from the ASIC providers like the Broadcoms, not competing directly with Nvidia's GPU right now, but I think in the long term, it is going to eat into the wallet share and the dollar spend that its customers would be spending on Nvidia GPUs versus their own ASICs.
All right, Kunjan, I know you don't recommend stocks and so on and so forth, but this 3-day rout that we've seen that has wiped off about 10%, more than 10% off Nvidia, it's, in your view, not because the fundamental story is coming undone. Maybe it's, for who knows what reason, but it's not because fundamentally Nvidia is falling apart.
Definitely not. We don't see any fundamental flags right now, especially over the last week.
All right, well said. Bloomberg Intelligence Senior Semiconductor Analyst Kunjan Subani joining us from San Francisco.
Well, from the Nvidia narrative to one about the U.S. rate environment and to another one of the most read stories on the Bloomberg today, it's about how just as optimism is growing among investors that a rally in U.S. Treasuries is about to take off, one key indicator in the bond market is flashing a worrying sign for anyone thinking about piling in.
Yep. Let's get into it with Bloomberg News economics editor Molly Smith in studio. Also with us is Bloomberg Intelligence chief U.S. interest rate strategist Ira Jersey. Ira's out there at BI headquarters in Princeton, New Jersey. I feel like I keep thinking of Lost in Space. Warning, warning, warning. And if you're too young to understand, Google it. All right. Treasuries on the cusp.
I know what you're talking about. Don't look at me.
You're not that young. No. I'm just kidding.
Not that one. Yeah,
all right. So Treasuries on the cusp of erasing their losses for the year, guys. Signs finally emerging that inflation in the labor market are both truly cooling. Ira, let me start with you. Traders betting that may be enough for the Fed to start cutting interest rates as soon as September. Is that what we're seeing right now?
Well, that is what the market's pricing. I actually suspect that the Fed will wind up waiting until sometime after the election to start its cutting cycle. But that's certainly why you've seen this rally. It's not because of supply, right? We actually get quite a lot of supply the next couple of days, but the fundamentals will still matter to the risk appetite for Treasury securities. They're still the most liquid, safest asset in the world. So when you have people who think that the economy is going to be slipping, and people want to just find a safe haven, they're still going to find Treasuries.
Okay, so let's talk a little bit about this idea that's raised in this article by our own Liz McCormick, the growing view that markets and that the economy's so-called neutral rate, the theoretical level of borrowing costs that neither stimulates nor slows growth, is actually much higher than policymakers are currently projecting. The idea that we are going to be high for longer or high for forever. Ira, what are you seeing when it comes to that front?
Yeah, this has been something that people in the market have been talking about for years, basically since 2022 and the inflation scare. It's, if the neutral rate used to be, say, 1%, it's probably meaningfully higher than that today because we have, significant shifts in the fundamentals of the economy, not to mention the fact that we do have additional pressures on trade flows and the like. You no longer have the globalization helping to keep prices low for certain items. So the general consensus among almost every market participant is that it is higher than what it was for the last decade. The question is how high, right? Is it at 2.5% more or less where the Fed thinks, or is it more like 3.5%? There are a lot of people who believe that that's the case. Now, I actually think my view is that it is closer to 2.5% than it is to 3.5 or 4. But the fact that a large part of the market and many market participants think that it might be somewhat higher, and maybe the Fed can only cut interest rates by 150 or 200 basis points to get to neutral, will matter, and that is in a lot of people's market narrative.
Molly, come on in.
Yeah, I mean, there are definitely Fed officials too, for what it's worth, who will say that the longer-term neutral rate, or what we call an economic circle, R-star, if you want to get a little wonky with the jargon there, is that they will even say themselves that they probably think that rate is higher than what it used to be. But I mean, Ira, just want to like clarify this with you too, that R star is not necessarily the terminal rate here, right? I mean, those could be two different numbers of where the Fed cuts to in this cycle versus the longer neutral rate over time.
Yeah, that's right, Molly. So if you think about where, no one really knows where R star is, right? You can't know it ex ante because the fact is that the economy moves. There's a lot of changes that will happen over the next 2, 3, 5 years for determining, where is R star. So, if let's say that R star is 3%, right, just as a number, then presumably in a weak economic scenario, the Federal Reserve will cut to below that number in order to try to stimulate the economy. But again, no one really knows exactly where R star is. R star in the 1980s was much different than R star in the 1960s or 1950s. And that we can empirically know because we have economic evidence of where both short-term interest rates were and long-term interest rates. The other thing that I think is missed by a lot of these discussions about R star is that the financial system and the way that we fund is meaningfully different now than it even was 10 years ago or even 20 years ago. No corporation funds with short-term debt anymore. Just doesn't happen, right? So is R star where the Fed funds rate, that's going to have a much different effect on a corporate business and CapEx and the like today than it did 25 years ago when 25 or 30% of industrial debt was short-term debt that was going to be affected almost immediately by what the Fed did.
That's a really good point.
Yeah. Just to build on that a bit, I believe it was Adriana Kugler, Fed governor, who was speaking last week there. She was kind of alluding to this as well in saying that, R star is not what dictates monetary policy. Like to Ira's point, like this is just like, I don't want to say like imaginative, but it's really just more of like a concept like in theory rather than in practice. And like what's more useful for policymakers is how to understand how restrictive policy is right now in the short term rather than estimating the neutral rate of interest in the long term.
Well, to that, I mean, the Fed has aggressively raised rates in the last year. We know that, right, before stopping. The U.S. growth has not fallen off a cliff. U.S. jobs market, I know there's a little bit of a debate out there, but it still seems tight, which makes one wonder, Molly, if the Fed policy is not restrictive enough right now and suggests that the neutral rate needs to be higher.
And then you also have the camp, though, who's arguing that monetary policy acts with long and variable lags. Just to throw that out there. But no, we all want to know. But no, that's exactly it, though, right? And that's exactly why, like, you're also wondering too, just like of the efficacy of policy in general and like the transmission method and like, do we have an economy that's just structurally more resistant to higher interest rates now than we did in past tightening cycles? That's also a possibility. And you look at like the percentage of homes that are mortgage free and, people who maybe are not relying as much on credit cards and like these ways that would actually like affect consumers more directly. And it's clearly not showing up in more clear signs of stress in those parts of the economy.
Ira, what happened to the neutral rate during the Volcker era?
Well, so the neutral rate was probably much higher, right? It was probably more like 6 or 7%. But part of that was that there was much structurally higher inflation. And to one of Molly's points, how those long and variable lags of monetary policy are going to affect things goes back to what I was saying earlier about who has the debt, what sectors are doing well. If you look at inflation today, inflation right now is driven almost 100% by services, which is two factors, right? It's housing services and then non-housing services, right? But the non-housing service part of the economy is not affected by debt. Most people don't borrow money to start services businesses or to expand services businesses. They use cash on hand. So the thing is that you're not going to see a significant slowdown. Now, it's much different than the 1970s or 1980s when companies were levering themselves and borrowed a lot of money in order to make to invest in their businesses and expand. That's just not the case today, right? So the fact is that we've shifted a significant amount of the way that the economy functions, where interest rates are more, at least in my opinion, are much more of a sentiment kind of indicator as opposed to having real effects on the economy just because of the structural shifts in how we do business today versus previous generations.
Okay, so on this, Molly, I'm curious about the reads we get later this week when it comes to the Fed's preferred gauge of underlying inflation. What's expected here and how could this sort of change the outlook?
Yeah, so it's probably going to be another favorable inflation print. I think most economists are penciling in just a 1/10 increase in the core PCE inflation gauge. So that would be, I think, the smallest since November, and pretty consistent with what we saw from the CPI and PPI reports a couple weeks ago. So, and I mean, look, I think like I know we talked about this last time too. I still find it just amazing how quickly the narrative has changed in terms of how we're thinking about inflation here. That we had the three horrible prints at the beginning of the year. We had 1 month that came in as expected, and now 1 month that's better than expected. And all of a sudden, inflation has resumed its downward trend. I'm not saying I necessarily disagree with that, but it's just amazing how we have really just kind of gone back to being fully optimistic that inflation is pretty much going down again.
Yeah, it's pretty fascinating, something we've talked about. Listen, both of you, thank you so much, really setting the right tone in terms of this week and what we are focusing on. Bloomberg News economics editor Molly Smith and Bloomberg Intelligence chief U.S. interest rate strategist Ira Jersey.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, Jeff Yass, not a household name, a libertarian, a billionaire, a Wall Street veteran, obsessive poker player, big investor in the parent of TikTok as well, Tim.
Yeah, we're talking about the company called ByteDance. He's a former Never Trumper who's recently become an okay, fine, might as well be Trumper. So writes Bloomberg's Annie Massa in a story that is among our most read on the Bloomberg Terminal. It is today's big take on the Bloomberg Terminal and at Bloomberg.com/big take. Annie Massa is Bloomberg News wealth reporter. She joins us here in the studio. Jeff Yass, okay, so he oversees Susquehanna International. As you write, it's a trading firm burrowed deep in the machinery of modern finance. He's a poker player. He wrote about options for his thesis in college. Why are we talking about him right now, though?
The reason he's in the news so much recently is he's a huge political donor. There are two things. He's a huge political donor. He kind of soared to the top of the list of biggest individual donors for much of this year in the 2024 election cycle. And then the second thing is that he is a major investor in an app that most of us have heard of, TikTok, or the parent company app, ByteDance, which might be familiar to a lot of listeners. So for those two reasons, this kind of stealthy, veil of secrecy that he's spent his entire career enjoying has been blown up in the past year.
What's more important, his political aspect or the TikTok? Or is it just that it's both of those things combined?
They're a bit wrapped together. So he is a major libertarian. And one of the things that I wrote about in the story is his kind of conversion when he was younger to like libertarianism, and how at various points in his life he called on Milton Friedman personally for advice, and has kind of built his whole career and reputation that way. So he's always been a big donor to libertarian causes. But as far as politics go, and as far as TikTok and Trump go, this perfect storm happened in the past year where he came on people's radars for having been such an investor in TikTok, and then this flip-flop that Trump did in terms of TikTok and banning TikTok also kind of pinged people's radars. Like, why is he doing this?
We'll have the two had a conversation.
That's right. So there was this moment where they had a conversation at a big Club for Growth event in
Not at Mar-a-Lago.
Florida. Not at Mar-a-Lago. It was at the Breakers Hotel.
The other.
Yeah, the maybe more stately, cousin, but 10 minutes away. And so this conversation happened, and Jeff Yass's camp says that they did not discuss TikTok, but subsequently, Trump, has come out in favor of keeping TikTok on the phones of all Americans. And subsequently, Jeff has come out and said he will not donate money to Trump directly, but he supports him in the 2024 election. A
big flip-flop for the former president who, during his administration, tried to get TikTok to divest its American assets back in 2020. We'll get to more of that, but I want to talk about your reporting process for this, Annie. Who did you speak to? Who did you not speak to? And talk a little bit about how you reported out this piece.
Sure. Without going through the entire list of names,
was it a long one?
Of people I spoke to, I did kind of try and get into people who've worked at Susquehanna or worked there. Friends of Jeff's. He has now gathered so much attention that there are activist groups that are organizing local campaigns in Pennsylvania where they're showing up and, protesting outside the office or events. So I talked to those people. So I just tried to canvass locally in Pennsylvania because he is the richest man in Pennsylvania, and donates a lot to politics at the local level as well as the Wall Street component.
Does he, when he donates to politics, is it both sides of the aisle?
No, it's really to conservative causes. He will donate in some cases, but his most major spending is for Republican
I think
causes.
what's interesting about this story, and you write this, a billionaire flip-flopping for Donald Trump is nothing new, right? We are increasingly seeing that as we get closer to the November election. So no judge. But why single out Jeff Yass? And what did you want to know in all these conversations that you had, that you really paint an incredible picture of this guy from kind of being a little kid to where he is now?
Yeah, I wanted to know, basically my unifying question was, this is someone who focuses a lot at a professional level on decision making, which might sound a little bit basic, but he kind of built this whole company, as you said earlier, on poker and rational decision making in poker. So I was trying to really suss out, okay, so if this is the moment in which he's, going publicly on record and saying that he supports Trump over Biden, these purposes this year, I was trying to get inside his head as much as I could without talking to him about why he's making that decision now. And so
like the bet he's making, essentially, right?
The bet he's making, exactly, and what matters to him. So of course TikTok matters a great deal to him. He's worth $47 billion, but about a third of that comes from this early stake that his company took in TikTok. So that's a piece of it. But there are other dimensions to it. He's a huge supporter of this kind of controversial program of school vouchers. So we get into that quite a bit in the story. Mm-hmm. And that is something that's very much in line with Trump's former education secretary, Betsy DeVos, is a major supporter of school voucher programs.
One thing that I really liked about the story was the history of Susquehanna and how the firm came to be. And you write in the piece, Annie, that even though it's a financial firm and a lot of financial, it's essentially considered part of the financial elite. This is not something that's on Wall Street. This is not a guy who has homes right outside of New York City and commutes into New York City. This is Pennsylvania that we're talking about here. Talk a little bit about the location of the firm and who he's had in his inner circle, what they've gone and done since they joined the firm and have left the firm, and sort of what you learned there.
Yeah, so Susquehanna is based in a kind of unusual place for a big Wall Street firm. It's based in Bala Cynwyd, Pennsylvania, which is a suburb of Philadelphia. And the reason that they were in Philadelphia to begin with, he got started trading options. Options are what kind of built the foundation of this entire company in Philly. But as I write in the story, he not a huge fan of taxes. So he's always optimizing for tax purposes, and by moving from Philadelphia.
Hates taxes. Like, it's pretty clear.
That is something, that's how people describe him.
Look, I think it's fair to say a libertarian doesn't necessarily love taxes.
The Club for Growth, right? Yeah. This group that he supports, as you say, it's an anti-tax political advocacy group, right?
Could accurately be described as an anti-tax
Some
person.
would say he really hates taxes.
Yeah, I mean, all sorts of people would tell you that. I'm sure Jeff would tell you that too. But anyway, so he moved the company from Philadelphia to Bala Cynwyd. Even that marginal little move, saved money, was savings on taxes. So you're tucked away.
He's allowed, right? Yeah.
Absolutely. But you're tucked away outside of the kind of fray of Wall Street. And they started with options, but they've expanded to all sorts of different stuff. Anything you can think of, really. Stocks, bonds, crypto.
Taylor Swift.
Yeah, they all event contracts. All of this, and lottery insurance, kind of policies, all sorts of those things. So that is something particular to the firm. And they have this culture where they train you using poker techniques and playing poker in Texas Hold'em.
This is fascinating, right? When he hires someone, right, they actually are playing this.
Yeah, because they want to see how you make decisions. How do you go about deciding what, when you're playing a hand, whether to bet, check, or fold? And it actually doesn't matter as much, do you win or lose that hand, because luck can factor in. But did you make the right decision based on the probabilities and the players around the table, and they want to know how you made those decisions. So and so to your question, a lot of proprietary trading firms that are now kind of giants on Wall Street, the people who run those firms are often from Susquehanna.
Like a Jane Street, for example.
Jane Street is the perfect example, yeah.
But people want to know, these people who are kind of protesting against him, they want, the public at large want to kind of say who he is, right? They want to get it out. They just got about 30 seconds left here, though.
They want people to know his name more, and they're trying to work to combat what they consider outsized influence in their state.
Right. Which is we talk about follow the money with everything and anything. And he's not alone, right, in terms of big political donors.
Yeah. Exactly.
Incredible story. So much detail. Another incredible piece of reporting, Annie. Thank you so much. Annie Massar, she's wealth reporter at Bloomberg News. As we said, this is among our most read stories on the Bloomberg terminal as we speak. It's also the Bloomberg Big Take, which you can find on the Bloomberg terminal at bloomberg.com/Big Take. So definitely check it out.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
June is Pride Month, and all this month, Bloomberg Businessweek is featuring voices on topics related to equality. You might remember, just a couple of weeks ago, we spoke to Sarah Kate Ellis. She's the CEO and president over at GLAAD. Catch that conversation in our weekend podcast, by the way. According to GLAAD, a study they did last year, 70% of non-LGBTQ people agree that companies should publicly support and include the LGBT community through practices like hiring, advertising, and sponsorship.
It was a great conversation. I feel like an eye-opening, and some statistics she shared with us in terms of acceptance, which is still an issue. She's been doing that, Sarah Kate Ellis, that is, for 10 years. And yes, progress, but there's a lot more to go when it comes to acceptance more generally.
Yeah, no question companies, for their part, have gotten more outspoken in support of LGBTQ employees. Yet, according to EY, a majority of these companies, or these employees at these companies, they still feel that sharing parts of their identity at work could hold them back.
So for more, we're joined by Karen Tornite. She is Global Vice Chair of Diversity, Equity, and Inclusiveness at EY, and she's joining Tim and me from New York. Karen, great to have you here with us. Talk to us a little bit about what you are hearing from companies when it comes to how members of the LGBTQ community feel within those companies. And I am curious, too, about EY and your own experiences, what you guys are seeing when it comes to this.
Sure, absolutely. First off, thank you very much for having me, and thank you for highlighting this important topic. I would say there's a few things happening. One, employees of all dimensions are actually, feeling greater pressures than they ever have, whether it be wars, economic pressures, xenophobia, increased political pressures, a whole host of things all around the world. And we're certainly seeing that. And I look at it as though employees are carrying an extra backpack with them to work each day. And I would say our studies recently showed that not only are our LGBTQ plus employees carrying a backpack, but perhaps even a heavier backpack with them to work each day. And at EY, and I believe at other companies too, we feel a piece of our job is to help lighten that backpack a bit. And it is particularly concerning because while employees rate workplaces as the second place most likely to belong, second only to home, but more so than their communities and their places of worship, et cetera. Work is always not always a workplace is not always a walk in the park for LGBTQ plus employees. And to your point, 3/4 of them in a recent study that we did around the world showed that there really are what I would call cautiously transparent, and they're not likely to necessarily share their identity at work because they feel that it will in fact hold them back.
And so that explain. How do you explain that, and sort of share the differences that you find in the research for how non-LGBTQ employees feel about sharing those own personal details at work? What's sort of the benchmark here?
Well, I think look, we do see from our studies that all employees are hesitant to share political affiliation. They're hesitant to share religion at work. They can also be hesitant to share other personal aspects. So that is quite clear. But it feels like from our studies that there's greater barriers, and our LGBTQ plus folks feel like they are less likely to be sponsored, as an example, and they tend to feel that they're over-mentored, meaning that they aren't endorsed for equitable assignments or for visibility or for opportunities similar to their non-LGBTQ plus counterparts.
Karen, a wise person always says to me, but are they right? Like, in other words, is it a feeling, or are they really not getting those juicy opportunities? Like, I am just curious, right? There's a feeling and then there's the reality. And it seems to me that the reality is that they're not getting those opportunities. What do we know on that front?
Well, I think there's a few things. One, not all LGBTQ plus employees are out at work. So it isn't necessarily something that you can measure as easily as you can, for example, gender identity, which people tend to be a bit more forthcoming about. So that's one piece. So you don't actually have all the data. The other piece is, I think you have to be able to explain, do you have the policies? Are you making for a respectful and safe workplace for everyone? Do you offer role models? And I'll give you an example, because it is an important piece for people to not only have affinity with peers and other colleagues and allies, but it's also really important. We've heard the old adage, you can't be what you can't see. I would say, speak for EY, that, we're no stranger to having diverse leadership. And it's really important for us to have out LGBTQ plus leadership, and we do at the country levels, on our management committees, on our boards, on our senior client serving capacity. And that really, really makes a difference, so that people can see, yes, you can advance to the highest levels within an organization. And I think that's particularly important, especially when people are seeing the workplaces around them actually retracting in some capacity, or feels like they're retracting.
So how would you advise companies? Because at the end of the day, that's what EY does. EY advises companies. They have a roster of clients. You tell them best practices when it comes to certainly to all aspects of business. How do you advise companies to shift at work, given what you found in your research?
Yeah, I think there's a few things. Tone at the top is critical, meaning that you have to have ironclad support for your commitment in this area. And that doesn't mean you have to do everything perfect, because none of us do. However, you have to be authentic, and not just during Pride months, which can vary around the world, meaning 12 months out of the year, that you have consistent commitment and tone at the top. Accountability, holding yourselves responsible for that. Also, pretty unsexy things, Carol and Tim, like policies, but that show employees that regardless of where you work, like at EY, we will offer you a safe and respectful environment. And that is our commitment. The other thing that you can do, which tends to be a little harder, is making sure that your systems are equitable, and that your pay equity systems are equitable, your promotion systems. And then the last thing that many companies, I see around the world that do a nice job of this, is offer affinity groups. And those, those are not a LGBTQ plus strategy, but they're a huge enhancement. For example, we have them in 77 countries, and we have, thousands of employees that belong to these networks. And that offers people not only role models, but it offers them the ability to share and have voice to leadership, so that it goes in two ways, not just with each other, but up through management. And we've found that to be really, really helpful in guiding our level of authenticity in this place, in showing our support.
And I'm always, one of the things that comes up, whether it's affinity groups or just groups overall, like, what you want is everybody to be a part of the whole, right? And you want to be careful about not dividing everything up and keeping people, yes, into a group where they feel supported, but you want to make sure that that group then is, certainly a part of the bigger, broader organization. So is there an understanding of that? Because sometimes I think companies will set up a group or something and then it's like, okay, done, we did it. Like we're helping out a group, right? The importance is making sure that they're a part of the whole.
Yes, absolutely. And you don't want to be an isolated group. So there could be some benefits, of course, to having, a similar topic and a similar concern or things that you're working through. Absolutely. But you need allies in that, regardless of the demographic group. But to your point, you also need to, this is not about fixing LGBTQ plus employees. This is about fixing environments and making sure that environments are as equitable as possible. So another example that you could consider to do is inclusive leadership behavior types training, which doesn't focus on people's beliefs necessarily. It focuses on how they behave in a workplace and how they could be a most inclusive colleague and team member to all of their employees. And we found that's been very beneficial to us in inclusion overall and belonging overall for everyone.
All right, going to leave it there. Hey, Karen, thank you so much. Karen Twarnite, she's Global Vice Chair of Diversity, Equity, and Inclusiveness over at EY, joining us on this Monday in New York.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes to go until we wrap up the trade on this Monday. Our Alexandra Semenova writing, the U.S. stock market pouncing from one all-time high to the next, but below the surface, she says a waning share of stocks is participating in the advance, spelling potential trouble ahead for equities. So Tim, she writes, bifurcation between the S&P 500 performance and breadth has reached one of the worst levels in 3 decades, according to Bloomberg intelligence data. The only 2 times since 1995 it's been as extreme as now came before drawdowns for U.S. stocks. So just something to think about.
That's really good. Introductory remarks, I should say, for our next guest, Emily Roland, who's co-chief investment strategist at John Hancock Investment Management. And that's because, Emily, you say that, hey, it's been a good run. That's the good news. The bad news is likely to start to mean that bad news for markets soon. So it's not going to be like, bad news is good news. It's like bad news is actually going to be bad news. What is the evidence for this shift that you write about?
Yeah, so thanks for having me this afternoon. So we are seeing the labor market shift. You look at some of the data that's come out as of late, initial claims rising over the last couple of weeks certainly isn't great news. We're finding that it's harder to get a new job after you lose one. Job switching is not resulting in wage gains the way that it has previously. So we're watching closely for this next jobs report to see signs that picture may deteriorate more. We're also seeing inflation slowing. Right now, that's a great thing because we have to remember that inflation was awesome for corporate profits, especially for companies with a lot of pricing power that could pass that along. It actually resulted in record revenue growth, but that inflation impulse is fading now. And we're seeing it in things like used car prices falling. We're seeing retailers actually start to make cuts. There's a few articles on Bloomberg today talking about fast food chains actually starting to cut prices here even. So we're seeing it at the high end, we're seeing it at the low end. Of course, housing is that last piece of the inflation picture that's really critical here. Housing is a huge component of CPI. And even though we're starting to see some cracks in the housing market, things like housing sentiment we saw last week are slowing, building permits, new housing starts slowing, house prices are still up. They're up 6% nearly on a year over year basis, which is pretty remarkable and shows the resilience of the housing market. So we need to see that inflation data come down on the shelter front in order to see the Fed start to cut. But remember, when inflation's slowing, that also means growth is slowing, margins are compressing, and corporate earnings are going to come down. So a long way of saying that this bad news ultimately is not going to be great for corporate profits.
Right. We also have Fed Bank of San Francisco President Mary Daly. She's warning the U.S. labor market is nearing an inflection point where further slowing could mean higher employment. That's our news story right on the Bloomberg. At the same time, Tim and I talked at the beginning of our broadcast about our Liz McCormick story about how long can high rates last. Bond markets say maybe forever. So I do wonder about what that means for the investment environment. So tie it all together. First of all, real quickly, recession or no recession then? Or earnings recession or no recession? What are you expecting?
We do see a contraction ultimately unfolding just the way it always has. We think there'll be some type of liquidity event or financial accident in the face of a higher cost of capital, which happens every time. Some sort of over-levered or lower quality player will get exposed, will have a contraction, or maybe it's simply the unemployment rate rising as margins compress due to that higher cost of capital and slower revenue growth. And by the way, that means it's a great environment to pick up the income that's available in high quality bonds. You just nailed it when you talked about the fact that bonds just haven't really sniffed this out yet. They haven't sniffed out lower growth and lower inflation, and bond yields are still up on the year. Remember, we started the year with the 10-year Treasury yield sitting at 3.88. We're right around 4.24 right now. So we've seen this backup in bond yields that to us is creating a really attractive entry point if you see inflation slowing, if you see growth slowing. Now, maybe it doesn't move in a straight line, but you can get paid to wait. High quality bonds are offering 5 to 6% income, and that is close to the highest levels they've been over the past 20 years. So bonds are mispriced to us in an environment where we do eventually see a contraction unfolding.
What do you see the 10-year doing in the next few months?
Yeah, I mean, we think it'll chop around before it eventually falls. If there is some type of great question. So, on average, if you look at the past few Fed cutting cycles, the 10-year Treasury yield falls on average about 2.5% from peak to trough. So that is a big drop. Say we peaked, right around 5%. That brings us down to a 2 or 3 handle on the 10-year Treasury yield once we get through the economic contraction. So if you're a big fan of bond math, that is a really attractive return from a duration standpoint. And then you get to add the income back in. So I think you could potentially even see double-digit returns across areas like the 10-year Treasury yield in that contraction environment.
So are you saying really what investors need to be thinking right now is much more fixed income exposure at this point and not equity exposure?
We still like equity exposure, Carol, and it's a very unpopular story to be talking about fixed income because it certainly hasn't worked as well as just owning that one big stock and kind of letting it ride. I do still think there's opportunities in equities. The challenge is the starting point. So stocks are trading at elevated multiples. If you look at the U.S. tech sector, it's trading at a 31 times forward earnings right now. And that is the highest since we were coming down from the tech bubble in the late 1990s. Now, there's an old saying that valuations are not a catalyst. There probably needs to be some shift in the macro regime. We need to see earnings across technology companies falter. And frankly, they haven't. And the tech sector's got the best earnings across all S&P 500 sectors. So the fundamental case for owning tech stocks is there. It's just the valuations are looking awfully egregious to us. So we want to own them, but we'll want to diversify by looking at places like U.S. mid-cap stocks, which are trading at the steepest discount to their large cap counterparts since the late 1990s. They benefit from an overweight to high quality industrial. So there's other areas to be in equities, but we like bonds to do some more heavy lifting in portfolios.
Emily, just want to end with an equity in the last 30 seconds. Shares of Nvidia down 6%, more than 12% over the last 3 days, $400 billion in market cap just gone poof. How are you watching it?
Yeah. I can't remember a time when one stock ever meant this much to the market. It's so remarkable. I mean, it's up 150% year to date, 200% over the 1 year period. So I think it certainly makes sense to expect some type of pullback in this name, but it's incredibly, it's amazing how important this one name has been to the broad market. Again, it's a high quality stock, great balance sheet, lots of cash. But the multiple is pretty extended here.
That mirrors our Kunjan Sobhani of Bloomberg Intelligence, who basically said it's a fundamentally driven story, whether you look at revenues, EPS, or market cap. It really at least from his perspective, makes an awful lot of sense. Emily, hey, thank you so much. Emily Roland, Co-Chief Investment Strategist at John Hancock Investment Management, joining us in Boston.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.